Hi, welcome to News English class. I'm your instructor, Dr. Ye. This MOOCS aims at helping you previewing essential course materials prior to your attendance at the classroom. Please spend sufficient time getting yourself acquainted with the contents provided. In our fourth episode of News English MOOCS, I will talk about the global recession by first introducing its definition, followed by a timeline of the Great Recession in history. By understanding the concept of global recession and its paradigm, we may get a glimpse of what goes on in the financial crisis we face today or in the future. This MOOCS is therefore divided into two parts: the definition of global recession and introduction to the Great Recession. A global recession is a period of economic decline that makes global impact. The global recession is commonly referred to the worst economic slowdown in world markets that hit the world's economies since the Great Depression in 1929. It is sometimes called the financial tsunami or the economic crisis. Here are some of the major recessions recorded in the history of financial decline after the landmark financial crisis in 1929. Now I will draw your attention to a more recent major recession took place during the late 2000s and early 2010s. It is known as the Great Recession. We shall see how the Great Recession came about, and we will look at some major occurrences through its timeline. Now we will take a look at its background. Bubble economy is the general background for the Great Recession. There arises in the price of assets that exceeds their actual value, and this market situation leads to overinflation. This situation is compared to a bubble. Now you need to know what mortgage-backed security is. It is a complex financial instrument by which debt owned by banks was bundled together and then cut into pieces and sold as an investment. Given the pricey assets at that time, properties were marketed around the world as mortgage-backed securities. It seemed like a good investment for the general public, but they offer higher yields because they offer higher yields or profits than government bonds. However, they contain much higher risks at the same time. As mentioned before, the price of assets was in fact only a bubble or an illusion that had exceeded its actual value. Therefore, when this kind of bubble economy bursts, it can seriously disrupt the economy. For example, the U.S. housing bubble during 2006 brought tremendous financial setback because the value of houses collapsed and caused subprime mortgage crisis when a home loan sold to people who have little chance of actually paying it back. As many of these securities were backed by subprime mortgages, homeowners began to default or fall behind on their mortgage payments in large numbers starting in 2007. In the end, many homeowners faced foreclosure when banks regained ownership from homeowners who failed to clear their mortgages. Now let's take a look at the timeline of the Great Recession. When the economy becomes a bubble, investment banks such as Lehman Brothers faces bankruptcy on September 15, 2008. It is considered the official start of the Great Recession. It created such a major panic that people make bank runs. A run on the bank occurs when a large number of customers withdraw cash from deposit accounts with a financial institution at the same time because they believe that the financial institution is or might become insolvent. However, a bank may come to the point when it runs out of cash and may face sudden bankruptcy. Then, governments started to step in and offer bailouts or financial rescues. For example, on September 16, 2008, AIG, which is the world's largest insurance company, was rescued by $85 billion loan from US government. Also, on October 3, 2008, $700 billion TARP rescue plan was approved to save the nation's banks. And on February 16, 2010, U.S. Congress passes $787 billion, which is called the stimulus package. It is worth noticing that on April 16, 2010, Goldman Sachs was investigated by the U.S. Senate for prime mortgage-backed security fraud. Some argue that the result of the Great Recession is due to regulatory oversight of the U.S. shadow banking system or non-depository financial institutions such as investment banks that operate outside normal financial regulations. It rivals with traditional depository banking system and make it vulnerable to a bank run. Now that we've covered the Great Recession, you may have an idea of what it can become a crisis when houses become overinflated, and we must be aware of the high risk in mortgage-backed securities when considering them a means of investment. This is the end of this episode. Please remember to complete the online test for this session before the deadline. I look forward to seeing you in class for further discussions.